Daniel Lehman coming to you for Volume 3 of the Lehman Group video newsletter. Everybody's heard of it. Last week, the Fed's cut interest rates by half, and I want to kind of talk to you about what that means for you. And there's a lot of misconception. A lot of people think that that means automatically interest rates on mortgages go down by 0.5%, but I think what you'll find is there's a huge that's a big misconception, and I'll tell you why. Basically, the Fed's #1 concern is inflation. That's what they're there for primarily, is to contain inflation. And so, in order to understand what's going on, first you have to have an understanding of what inflation is. And at a very layman's terms, so to speak, inflation is a lot of money in the economy chasing very little goods. And what that does is the heavy demand with low supply forces costs for goods to go up. As prices increase, the value of your dollar over time drops. So if you have watched these video blogs before, you understand, or if you talked to me before, you understand that mortgage-backed securities and bondholders are what determines interest rates. So bonds determine interest rates. Bondholders do not like inflation. So if that's happening where there's a lot of money in the economy and prices are going up, all that means is my value of my investment in this bond over time is being eroded. So, for example, say I loan you a mortgage for $200,000, and your payments to me are $1,000 a month. That's all well and good. Over time, the payment is the same. However, if there's a lot of inflation in the economy, in the market, that $1,000 over time doesn't buy as much. So, it's the same $1,000 check that I'm getting every month, but I can't buy as many goods and services with that check as I could before. So what that means is I might increase your interest rate if it looks like there's if it looks like there's going to be a lot of inflation over time. What I'll do is I'll curb that. As a bond trader, I'll raise interest rates. I'll raise my rate, and I'll say, hey, you're not going to pay me $1,000. Because of this inflation in the market, you're going to pay me $1,500, and that'll curb any kind of inflationary pressure in the future. So an example of why inflation isn't good is basically, even if it averages about 2% a year, a $20,000 car in 25 years would cost you anywhere from $35,000 to $40,000. So your Civic today is going to cost you BMW prices tomorrow. And again, that's just an example of how over time it erodes the value of the money that you have. That's why you want to have your investment somewhere that's at least beating inflation. Hopefully you're doing much better than that, but if you just have your money in a box somewhere, that money is sitting there, it's not making anything for you, so it's basically losing money, because over time that money is not going to be able to buy as much in the future. So that should be a huge part of your planning process. So Fed's #1 concern is keeping inflation in check. How does the Fed control inflation? Typically, the way the Fed controls inflation is their #1 tool is the Fed funds rate. Same Fed funds rate that they just dropped by 50 basis points, or 0.5%. What the Fed funds rate is basically the definition of the Fed funds rate, or what it is what the Fed sets a rate where Bank A would loan to Bank B money over a period of time. So that doesn't mean as much to you as what the index is used for. The Fed funds rate is tied directly to the prime rate. The way it works is this. The formula for the prime rate is this: Fed funds rate plus 3% equals prime rate. So credit cards, home equity lines of credit are a big one. Some credit cards and other stuff is tied to prime. I'm sure you've heard the term prime before. So Fed funds was at 5.25, plus 3% is 8.25. So your home equity lines and everything, your prime rate is 8.25. Fed funds just dropped the interest rate to 4.75. So 4.75 plus 3, 7.75, and that's how you figure out what prime is. So what does this mean? If we take it down this path, your interest rates, everybody's interest rates on short-term money, credit cards, home equity lines, things, auto loans, just went down by 0.5%. Might not be a huge difference in your life personally, but across the vast array of the economy, that's a lot more money that's going to be liquid. If you're not paying for interest, you have more money to spend on whatever. And the reason why the Fed dropped interest rates this time was basically to save an economy that looked like it might be heading for a recession. If everything is tied up too much or interest rates are too high, you can almost go into a deflationary environment. Basically, the Fed dropped rates to increase some liquidity in the market so that people weren't getting killed with this credit crunch and everything else and with troubles in the housing market. But what that does is, across the economy, that means you're not paying 8.25% on your prime rate anymore. You're paying 7.75%. So that little difference is a huge amount of money that's in the economy. So more money in the economy means more money, again, chasing less goods, and that means that there's inflationary pressure. So what do bond traders look at that as? An inflationary pressure. So in short, Fed cut rates, short-term interest rates are going down, directly tied to prime right away. However, don't think that interest rates are going down for long-term mortgages, because that's seen by bond traders as inflationary. They drop the interest rates, more money in the economy, more inflation. More inflation means higher interest rates and mortgages. We've been holding up pretty good, but I'm thinking over the next, who knows, as these numbers start coming out, we might have to be staying on top of this. So basically, that's somewhat how it works in the environment where when the Fed was increasing rates, they were trying to curb inflation. Now they're dropping rates because they might have gone too far, or they're trying to increase liquidity. They're always trying to find a balance. They're always trying. It's kind of the not too hot, not too cold, Goldilocks porridge analogy. You don't want interest rates too high, so it's suffocating everything. You don't want interest rates too low, so inflation's out of control. So they're always trying to find that middle ground. So that's it. My phone's ringing apparently, so I'm gonna have to let you guys go. Give me a call. Any questions? You want to talk anything over, and I will be happy to. Hope you're doing well, and I'll talk to you next week. Take care.